Good afternoon and welcome to March Madness, digesting Q1 and the latest FOMC projections. I'm Terrence Richardson, and it's a pleasure to be your guide today as we delve into how different rate cut scenarios might affect you, your hedging strategies, and how you might use this insight in your particular situation. Before we get started, I have a few housekeeping notes to ensure a smooth experience. Today's webinar will run for approximately 30 minutes with a dedicated Q&A session following the presentation. We invite you to engage with us through the chat function. Our team is ready to respond to your input. If you run into technical difficulties, please use the chat for assistance or email info@derivativepath.com. Rest assured, we're recording the session and all attendees will receive a link to access it afterwards, along with the presentation slides. Additionally, we've provided a link to Isaac's last article, Hedging Strategies from Q4 2023, and Frank's recap of our last discussion, Navigating 2024's Rate Volatility, 3 Key Risk Management Strategy Takeaways. At the conclusion of this session, a replay will be made available to you. We respect your time and will keep to our schedule, ensuring we finish on time. For more insights and for updates after this event, follow Derivative Path on LinkedIn and visit our website. Now let's turn to our discussion. With us today are industry experts Frank Fiorelli, specifically an expert in customer loan swaps, and Isaac Wheeler, focusing on balance sheet hedging. They're here to share valuable insights and strategies that can help both your customers and your institutions manage interest rate risk. I've recently read that liquidity management is top of mind for banks and credit unions. Deposit growth remains an industry-wide challenge. Scarce liquidity is leading to supply-side contractions, while elevated interest rates are slowing loan demand. Isaac, if this is top of mind for executives, what surprised you from bank earnings season, and what has surprised you from Q1 so far?
It's a great question, Terrence, and maybe let's start with the earnings season aspect of it, just because we have a lot of great data on Q4, and I start here with the data that we pull out of earnings calls. To our clients that have worked with us for many years, or other institutions that we've spoken with, you'll know that every quarter we look at every bank earnings call that's out there from a publicly traded standpoint, and we look at those for comments around customer hedging programs. We look at it for comments around hedging against lower rates, hedging against higher rates. And we combine that data to give our clients a feel for what others are executing and for just hedging trends in general. And I think when we look at Q4, the first thing that jumps out to me is that hedging flows became a little bit more balanced. We continue to see hedges against rising rates get executed, which is comforting to me. The last thing we want to see is, now that there is a media focus on declining rates, now that the Fed is themselves starting to acknowledge a decline in policy rates possibly coming later this year, the last thing we want to see is our clients take off the ball from an upside rate risk standpoint. So our clients that are exposed in that way, they continue to execute hedges. You see here that we've pulled an anecdote from an earnings call where an institution took advantage of the decline in rates in Q4 to add to their pay fixed swap hedges. Now, those are great things to see, and we hope to continue to see it as we go through the rest of this year. When it comes to a downside hedging program and the flows there, it was, I think, interesting to see that we saw more of that in Q4. And some of that's just a natural response, to human response, really, at the end of the day. Now that the Fed is talking about cutting rates, now that the market is anticipating it to a degree, obviously we're going to see more institutions get concerned with downside rate hedging and execute those types of strategies. In Q1 so far, I would say if there's been a surprise, it's been that we haven't seen more of that. I think to some degree, and we've addressed this on past calls, that can be chalked up to the expense of that sort of a hedging strategy. If we take floating rate assets today that are yielding, just from a pure SOFR standpoint, ignoring spread, 5.3%, and we convert or extend that out to 3 years, we might be giving up 125 plus basis points, 150 plus basis points if we go out further of income. And that's very challenging to do in an environment where, to your point, Terrence, there are a lot of other headwinds that are impacting financial institutions. So I think, one thing as we move through the rest of the quarter, I hope that we continue to see more of those strategies executed among clients that are exposed that way. But it has been encouraging and I think surprising that we've continued to hedge against higher rates as much as we have, because that's what we want to see. We hope that the lessons of this last rate cycle are sticky and institutions fundamentally think, change their hedging programs to be more proactive. And so far, that looks to be the case.
Great. Frank, what do you hear from your clients? Do you think that the elevated interest rates are impacting loan demand?
Perfect. Yeah, thanks, Terrence. Hey, everyone. As we've had our conversations with clients thus far, and we've looked through specifically the Q4 earnings releases, I think what was encouraging was the number of references to customer hedging programs was probably some of the highest we've seen in a number of years. But that's been followed up by volumes in Q1 on the slower side. I'd say almost to the tune of 50% of what volumes were in Q4 of 2023. So the surprise, I would say, has not been a pleasant one. And I think, when you look at it, you take into account the seasonality of it. You have the end of the year, loan pipelines are cleaning out. To begin the year, business owners are getting their year-end docs in order. There's some component of the 2023 credit hangover still factoring in. And then certainly on the rate side of it, you have just in January, loan rates were rising, term rates, that is, 40 to 50 basis points. So that didn't help matters. But at the same time, I'd say our travel schedules have been packed. We've had a very high volume of in-person Zoom Teams meetings with a number of bank management and lending teams during Q1. So the recognition of the importance of the program is certainly there. And circling back to the Q4 earnings releases, probably one of the most widely noted items in these releases is the non-interest fee income that's being earned out of the customer hedging programs. And so, I understood in today's environment, banks are looking to squeeze as much blood out of the stone as possible. That fee income can really make a difference. It can really make a lot of sense to be putting out there in your earnings releases. Anecdotally, we've always felt that with a bank with a proper and efficient hedging program should be generating anywhere from $750,000 to $1 million in non-interest fee income per billion of assets. So it can certainly move the needle. So understood there. But before moving ahead, I would like to remind the group and take a step back that the purpose of a customer hedging program is not solely to generate fee income. There are notable benefits with utilizing derivatives in loan programs, such as the customization and flexibility available, especially in today's environment, to help win a deal. And so, your customer is always top of mind alongside the bank when it comes to the why of a loan hedging program. And it's nice to see on this slide, one of the banks specifically addressed how having this customer program in place to help them win a deal. So that's great. And more on the positive side, in a lot of the conversations we've had during Q1, it seems like the sentiment is starting to shift. And from a more formal source, if you were to look at the senior loan officer survey from January, it points to the trend changing a little bit. We've had those banks have reported commercial real estate, C&I lending starting to creep back up after probably 3 quarters of contraction there. The number of banks that have reported tightening standards have come down from a 3-year high. And then the number of banks reporting increasing spreads have come down from a 15-year high. And so one extra tidbit I throw in there related to spreads, as we get the question so much, is, where should I be thinking about spreads on these loans compared to where we were last year, specifically before March's events? And I think the rule of thumb, or what we've seen in practice for the deals being executed, is that a credit that you've been underwriting and pricing deals at a year, 2, 3 years ago, that same credit is now pricing 20 to 30 basis points wider. And so I think that's an important thing to keep in mind as you're moving forward in pricing new opportunities in your pipeline going forward. So all in all, started off with silver volumes here in Q1, but with these conversations and these trends that we're seeing, we're hoping to probably surprise to the upside from a volume standpoint in Q2 and Q3.
And Frank, maybe even one thing I would say too is, from a balance sheet hedging standpoint, the one thing that I'm trying to remind our customers about as well is that the purest form of a balance sheet hedge is in some ways a customer loan swap, right? It's one thing to have the conversations we're having with clients today about hedging maybe legacy fixed rate assets that were on the balance sheet, where maybe we're swapping a pool of mortgages back to floating, or we're trying to term out some floating rate debt that's on the balance sheet. Those are seasoned assets that have been on the balance sheet for years. You really want to manage rate risk, you got to hedge assets at the point of origination. And I think customer swaps are one of the purest ways to do that. They're a very, valuable tool in the toolkit from an ALM standpoint, not just a revenue standpoint. So I've been, I think, very happy to see the amount of engagement we've had with clients about customer hedging programs, because I think to your point, it's not just about the income, it's about managing interest rate risk and delivering what your clients want as well at the same time.
I'm sure many of our listeners can sympathize with your observations. Keeping with the rate cuts, the market keeps pushing out the timing of rate cuts. Do you think we'll see a rate cut in Q2? And if so, how long should depositories be preparing for a declining rate environment?
I could take a first stab at that. And again, we're going to be looking at this from putting our lending caps on here. So as we are currently sitting here on the webinar, we're got roughly 60+% chance of a future implied probability of a rate cut come June. So there's your Q2 cut. Last week, the Fed didn't alter its plans for 2024 in the dot plot. They still have a median of 75 basis points worth of cuts in 2024, which pleased a lot of the doves out there. But when we're looking at the importance of a Q2 rate cut as it pertains to customer hedging programs, I think, to be honest, it's not as much of a concern. For me, it's more of a psychological event than anything, because there's still ways to go after this first cut. It's not like the soft landing that in the 90s where we cut 75 basis points and that was the extent of it. We still, from where we sit now, have another 1.5% to 2% worth of cuts left on the docket here, which also brings up another interesting point. So once we get through with these cuts, what is the neutral rate for the U.S. economy going to be? I mean, there's quite a varied amount of opinions around that topic on how close to 3% will that be. And we've already last week saw that the Fed's longer run median rate begin to creep up a little bit from 2.5 to 2.6%. And then from there, we move on to the next question. Once we get through these cuts in the next 12 to 18 months, how long until the next potential hiking cycle? And so really, until these questions have a bit more evidence surrounding some semblance of an answer, we're going to be in this very unsettling and volatile point in the market when it comes to swaps and the rates available for this loan level hedging. And from the bank's perspective, I think, and Isaac will probably touch upon this a little bit more, is what our beta is going to look like in a potential slow, methodical cutting cycle. Obviously, the concern on the bank side is that the interest income on these floating loan portfolios will come down immediately, but the cost of deposits and their funding, that remains to be seen. But I will say, even though concerns over floating interest income coming down, with the current inversion of the curve, as Isaac mentioned earlier, and swap pricing, it still presents really a near-term superior return than if the bank had just offered a fixed rate loan, the same as that swap rate. From a customer perspective, I honestly think a few cuts might be helpful, given the mindset of a lot of the customers, business owners that we've been speaking to over the past few months. Right now, they're so focused on there being cuts, and as a result, many erroneously believe that this will lead to a material decline in term rates. As an example, right, as I just mentioned, markets are pricing in about a 75 basis point decline in overnight rates by the end of 2024, but by virtue of using forward starting swap pricing, it's really when we're looking at the 10-year point of the curve, 10-year rates are only expected to come down 10 to 15 basis points lower over that same period. And so for your customers out there that are playing the let's wait for term rates to come down game, that might be an unfulfilled prophecy that could create some serious heartburn and problems for both the customer and your bank included.
Wow, a lot to think about. Isaac, before we switch gears, do you want to add to any of Frank's insights?
Yeah, no, absolutely. So, I think that when it comes to a rate cut in Q2, I think that there's no question that if the Fed can cut in July or June, they will. They would love to start to take their foot, off the gas from a rate, tightening standpoint prior to an election, well in advance of an election. The real question is just, is the inflation data going to cooperate and allow them to do so? I think that inflation is still, it's a very fickle thing. It's been well established that we're not particularly great about measuring it. There's a lot of different measures out there. I think we've seen PCE kind of in recent prints be very cooperative, whereas we've seen CPI and PPI come in a little bit above consensus. And those inflation prints will be critical between now and the summer. So I think we could see it, but it's going to be a binary event. And I think that goes for, really, to be honest, maybe even the rest of 2024. If the Fed is successful in cutting rates, in their desired window and avoiding, and believe me, there is a window, because I think they'd love to avoid, any semblance or any, possible interpretation of what they're doing is political. then they might be on hold for a little while. So I really think that'll be something to watch over the next few months. Now, if that declining rate environment comes to pass, or the depository believes it will, or they're exposed in that way, I think ultimately that's what matters. Are they exposed that way? Then I think now is the time to be hedging. I mean, we're of the believer that, of course, there is a cost of hedging that perhaps you shouldn't pay. But if you're fundamentally exposed to a declining rate environment and you're expected to outperform in higher rates, now is the time to be taking some chips off the table and establishing some downside rate protection. We talked earlier about the earnings impact of doing so. I think that there's ways that we can get creative, as we've alluded to in past webinars, around potentially forward starting trades or looking at option strategies to try to do so in a way that's friendly to earnings, because we're cognizant that while earnings, current earnings shouldn't drive necessarily all of your hedging strategies, it's a constraint that we need to work around. So I think we have some ways that we've worked with clients to try to address those concerns. And then I think the other thing they shouldn't be doing, you've asked what they should be doing to prepare, what they shouldn't be doing is turning off their customer hedging programs. It's a self-serving comment, but I do think that the value of a customer swap program more than ever isn't that it just gives the bank a floating rate asset. The value of a customer hedging program is that it gives the bank repayment protection, market-based pricing, real pricing discipline, and it helps you retain really valuable relationships. And so I don't view that as a product that you toggle on and off. That's a product that the bank stays committed to while managing interest rate risk in the background with a macro level hedge.
Okay, that makes sense. You kind of touched on it, but I think it's easy to forget that rates may remain high for some time. Isaac, how should FIs be hedging higher for longer environments?
Yeah, no, it's it's a good question. I think at the end of the day, if banks, fully, and credit unions alike, if they fully understood their exact interest rate risk profile, then there's an easy answer here. Today it's very attractive to convert fixed assets to floating. It's beneficial from an earnings standpoint. It brings the institution closer to neutral, which is always attractive. So I think that's actually probably one of the easier strategies to execute in this environment. What we're also trying to suggest to our clients, though, is that they look at option-based strategies as well. Now, options are challenging because they cost a premium. No one wants to execute a hedge that costs you something. I know that's ironic. Insurance is fundamentally something that you pay for, is our belief. But I think in this environment, institutions should be, can do either. And, the market pricing and this inversion on the curve, I think, is currently fairly attractive for those sort of strategies. Maybe the one suggestion we'd have is, like I alluded to, looking at option-based strategies that don't add unnecessarily to exposure and lower rates, because to Frank's earlier point, deposit betas may remain sticky, and we might have a little bit of uncertainty around how we're actually positioned in a lower rate environment. So I think those are a couple of things to keep in mind.
Yeah, thank you, Isaac. Frank, did you want to expand on Isaac's thoughts?
Yeah, of course. And I think Isaac touched upon it just prior, but this higher for longer risk highlights exactly why maintaining discipline within a customer swap program is important. It's not just a faucet that is turned on and off based on you or your customer views about where the rate environment is going to be in the future. I mean, the core principle behind the customer hedging program surrounds your bank underwriting and approving a specific return or spread based on the bank's presumed cost of funds and that given customer and their credit worthiness. And with a swap program, it eliminates that risk for that spread to be reduced in a higher for longer environment. But even still, given the context of a higher for longer current rate environment, the Fed still has to cut by 1.25% just for the interest income through a customer hedging program on a 5 to 10 year swap loan to reach that break-even level had your bank gone a fixed rate loan at that same swap rate, if you will. And this isn't including any upfront swap revenue that the bank would be targeting. So really, if a bank is concerned about near-term financials and, given the context of this webinar, March Madness, you get the survive and advance type mentality. We hear from a lot of banks that a term thrown around survive to 25. I mean, just having this customer program in place now certainly makes a lot of sense. And then from there, the risk for higher for longer only strengthens that stance. It's not quite the same environment we were in back in 2020 and 2021, but the concepts are similar. And so I'll go back to the point I made previously. not only if we stay higher for longer, but if the neutral rate does turn out to be something higher than the mid twos, then there could be some serious long-term pain for bank returns, which is completely eliminated if you do maintain a consistency within your loan level hedging program.
Okay, that makes a lot of sense. So I'm sure that the Fed will be extra cautious as we get closer to the election. Frank, what is the most underappreciated source of risk you see clients taking today?
Yeah, I think it's twofold, and these are really red flags and alarm bells as we're having these conversations with banks in these first couple months of Q1 here. And so I think the first one, I'm going to tie to some of their existing customers, some of those high value relationships. I mean, obviously you have deposit risk. We learned last year that with today's technology, with the click of a button on their phone, they can move deposits from one bank to another. But I think more so with the relationship aspect, it's with your existing deals or existing loans that are coming due or maturing in the next 1 to 2 years. We've had underwriting standards change. We're beginning to see private lending come back into the picture. And so in 1 to 2 years, there's going to be competition when these loans reprice. And depending on the rate environment, it may be difficult for your institution to keep these names in-house when the time comes. And so as we've been working with clients in Q1 to help eliminate some of that risk, one solution has been forward starting swaps, which at its core, the way that works is you look at a loan that's going to be maturing in the next 1 to 2 years, that when they first entered into that loan, rates were a lot lower, so they have a very attractive rate. So in doing so, the approach is you lock in a forward starting swap today that'll begin at the maturity of that loan. You extend it out 5, 7 years. So you amend your note, you extend the lending relationship with them another 5, 7 years, and your borrower gets to maintain that nice low market rate that they locked in years past. And then when the time comes, they're locked in even for that next 5 or 7 year term at the fixed swap rate that we lock in today. And the nice thing for the banks is when we're doing these forward starting swaps, even though they're not becoming effective until that 1 or 2 year point in the future, they're recognizing that fee income upfront today. Again, looking good for those near-term financials for the bank. The next sort of underappreciated risk, and again, it comes back to that point of banks trying to determine, should I use a swap, should I not use a swap, is weighing fixed rates versus doing a floating rate with the swap. And so the misconception that I think a lot of banks have is that fixed rate loans are going to protect me from a recession. If rates really go low, now I have this fixed rate loan on my books that I'm going to be recognizing that delta between how low rates have gone and where this fixed rate is. And I think, unfortunately, with the negative convexity in loan portfolios, we always say from a modeling perspective, yeah, a fixed rate loan looks great in a recessionary period with rates as low as they are. But in practice, that's not always the case, right? I think as you have these conversations with bankers and I present the scenario, hey, for this particular customer, if the Fed decreases their target range down to 2% or lower, will your borrower keep that fixed rate loan in place, or are they going to look to refi at a lower market rate given that environment that we're now in? And usually, almost always, the answer is, yeah, no, my borrower is going to come to me and refi. So that protection that you thought you were getting with a fixed rate loan doesn't actually get realized. And it's a very similar concept to having floors in your loans. We've had a ton of questions about that. Is should I be putting a 2%, 3% floor in my loan? And again, from a modeling perspective, that looks great because if SOFR goes below that level, you'll be compensated the difference. But if we get to that point and SOFR is down below 2%, I don't think you're ever going to realize the actual value of those floors because your customer will just be refining the loan anyway, and so that floor will disappear. And truly, the only real way to recognize the value of a floor is, as Isaac alluded to, a true ALM hedge and buying that protection. And that's the only way to keep that protection in place if it really is something that from a bank return standpoint that you're concerned about.
Wow, it's really eye-opening. Isaac, are there any balance sheet implications that you'd like to expand on?
Yeah, no, absolutely. We touched on it a little bit earlier, and Frank obviously covered a lot there. But to me, it's I think there's this sense, broadly speaking, that we always and this is something that I think we always deal with in hedging markets and financial markets in general, and that is that currently all that we can talk about in the rate space is when is the Fed going to cut rates? How quickly are they going to cut rates? I think the risk is that rates remain high and that institutions may not get bailed out from a deposit cost standpoint, from an OCI standpoint in terms of underwater bond portfolios. I think there's a real risk that rates remain high. I mean, I touched on it before. Inflation is is a challenging economic phenomenon to understand. I think if we felt like we understood it before, we've gotten a heavy dose of humility over the last couple of years. And so that's where really my mind is at mostly is, institutions that have a deep underwater bond portfolio, and they're just waiting for, that to be alleviated by a cut in rates. I think that's one that I think about in particular, because also when we talk about assets that are priced off the term part of the curve, the Fed may cut rates and we may see long-term rates climb up. We may see long-term rates higher, even if the Fed starts to cut rates. And there's a corollary to, as well, to Frank's world with customer swaps. Customers are saying, well, when's the Fed going to cut rates? That may not have the pricing benefit that they expect when it comes to the pricing on 5, 7, or 10-year products. So kind of a risk there that I see for both, I suppose, the end users or end clients of our banks, as well as kind of themselves when it comes from the long end of the curve in particular. I think the other one, and we looked at kind of a page here that we've got had it pulled up for the last few minutes, just mapping the last 5 years in rates markets. We've talked about it before, and, our clients that listen to these repeatedly will think that we sound like a broken record, but I always go back to the mid-2020 example. The risk that we were speaking about in mid-2020 was negative rates. Our bank's going to survive and thrive in a negative to flat rate environment. That was where our focus was. So today, if all the attention is on rate cuts, the timing of rate cuts, and the soft landing thesis is all we're speaking about, we're really missing the purpose of hedging. We've got to be cynical. We've got to talk about what is not being anticipated by the market. And so our attention should really be anywhere but the slow 150 basis point ramp down in rates from an ALM hedging standpoint, obviously. So that's really, I think, if it comes to an underappreciated risk, I think that's the one that looms large for me, the risk that rates stay high, go higher, especially at the long end.
Great. Thank you for that. So we have about 10 minutes left. I'd like to ask you, what's the one takeaway for depositories as we head into Q2? Frank, why don't you start, and then Isaac, you follow up on Frank's response.
Sure. Thanks, Terrence. And I think as an advisor, it's easy for me to say this, but truly education is the key here in this environment. And I think it starts internally with looking at bankers and leadership, both sides of the house speaking with each other. The simplest form of education, if you're going down to the banker or lender level, is, are they aware that swap pricing is currently the most attractive option when pricing a new loan, right? For competitive deals, are we mindful that we're submitting term sheets on the same days compared to my competitors? With rates moving 5 to 15 basis points per day, even a few days difference in that submission of the term sheet can make a difference. And you never want to just eliminate yourself from a competitive deal because you're submitting on a day that's different than your competitor is. And then at the top of the house, I think a lot of educating yourself about what's going on in the market, my particular market. What kind of spreads make sense for our lending basis? I think, obviously that depends on competition. It depends on selectivity, your bank's internal return hurdles. But in general, spreads since last year have increased 20 to 30 basis points for the same credit. And so if you're a bank that's coming in here and saying, well, in 2024, my goal is to increase spreads 75 basis points from where they were last year, I think you might be in for a little bit of realization where you're going to lose a bunch of deals, and it comes down to the bank and making those internal decisions as to how tight you want to be pricing, how many new deals do you want to be able to print in this market environment. And certainly, as I mentioned it before, do we need to have these floors in these deals? Because that's another source of kind of pricing that can make you uncompetitive in any given deal. And then I think, again, with education, educating your customers on new deals or what's going on or what options do they have available for their existing financings are available can open up a whole new source of opportunity for the bank. I mean, when looking at a new deal, for a customer, it's important to understand what are their concerns and what's their actual conviction about rates going lower. Is it something that I mentioned before where are they just concerned about 1, 2, 3 cuts because that's already priced into the curve? Or did they really have, conviction that we're going to be getting back to 2020 levels, whether, right or wrong? You have to be able to kind of offer where your customer is expecting. And so we always have this waterfall, right? For the customer that may just think what it might be 25, 50 basis point cut by the Fed is going to impact my term rates, just helping them understand what does the forward curve look like and will this actually change term rates? And then you have a customer that might say, well, I understand what's going on in the market, but I'm just not comfortable locking in a 7 or 10-year rate. And so with that, maybe the solution is, hey, we'll do a 3 or 5 year swap. You put that on a 10-year loan. And then with the idea thinking in 3 or 5 years from now, we'll enter them into a new swap to hedge their risk at that point in time. And then on the complete one end of the spectrum, for those customers that truly believe rates are going back down towards the 1% range, we can look at offering an interest rate cap where they pay a premium up front and they can truly float down to those extremely low levels. So it's listening to your customers, educating them, and then applying the appropriate lending solution for them. I think if anything, this volatility is here to stay, right? And Terrence, you mentioned it before. The political risk is right around the corner. And, in this election, right now, probably in prior elections, the U.S. economy was more in the forefront, but now you have these candidates who are going to be more focused on geopolitical risk, domestic political and legal issues. So it's going to be harder to get really a good sense on what this election is going to be doing to rates over the course of the next 1 to 2 years. But don't want to go too far into that because obviously we'll 5 months from now look forward to everybody joining for the election webinar that we'll be holding. But certainly, again, this volatility is a consideration, and educating everybody in-house and within your customer base is really what I find as the key point for depositories in Q1 here.
Well, Frank, I guess first off, appreciate you committing me to an election webinar. We'll look forward to that in 5 months. The place that I start in terms of takeaways, and I think the first one is, and I don't think that this is, if you're on this webinar, you're an institution that's considered hedging, you've implemented hedging strategies in the past. We don't need to convert you on kind of the value of hedging or eliminating rate risk and the effect of it on earnings and capital, et cetera. But where I go is the highest performing institutions that we work with recognize that hedging their balance sheet is not just a once a year, twice a year event. Your balance sheet is constantly changing. And the institutions that we work with that have had hedging programs for several years programmatically evaluate their risk position each month and hedge accordingly. We talked about this earlier in the conversation, but if I'm going to take seasoned fixed rate product, again, to use the mortgage example I've been speaking about during this conversation, and convert it to floating, well, now suddenly there's going to be a real conversation about timing of that hedge internally with management, with ALCO, et cetera. Is this the time we want to convert these assets to floating? What if we wait? If we hedge at the origination, as this risk comes to our balance sheet, well, then at that point, the conversation around pricing and timing goes away. And I think that that's critical when it comes to running an efficient hedging program. It's got to be ongoing, and it's got to be more than just an annual or biannual event. Rate risk is always there, and we need to address it as it comes onto the balance sheet, not debate how to manage it years after the fact, after we've originated loans or after we've brought interest sensitive liabilities onto the balance sheet. The time to hedge them is early on.
Thank you. So we have a few questions that have come in during this discussion. The first one is from Mark, who asks, do you have any examples of how the market or your clients are rethinking pricing in light of the regulatory changes that are coming? Isaac, why don't you field this one?
Yeah, I think when it comes to pricing, and maybe Frank, you can also chime in here. I feel like it might be an opportunity for a lot of our clients to compete with maybe some of their larger brethren that will be perhaps more affected by Basel Endgame. I think there's an opportunity there for maybe some of our smaller clients. The other thing I'll say just from a general regulatory standpoint is, I think that there's going to be a lot more regulatory attention on the topic of rate risk generally. So having this sort of capability from a hedging standpoint is going to be important to show your regulators, particularly if you're an institution that has a profile that's not just through your normal course of business. It's not, neutral to begin with. I think this capability is going to be important to demonstrate. And that's something we've heard anecdotally from institutions we've been speaking to. For better or for worse, we've obviously been through this cycle. Perhaps we're near the end of it, and interest rate risk has been, ultimately the source of the downfall of a couple of failed institutions. That's going to be a major regulatory focus in the years ahead, right or wrong. So I think establishing this capability today is something that's important. Frank, anything you want to add there on the pricing standpoint from a maybe the loan level world?
Yeah, no, I mean, I think you bring up a good point with regulation. Some of these larger banks, we've actually seen it in some of the data. I think along with the regulation, they're just more highly scrutinized by the regulators. And so we've seen just in Q1 alone, whereas a lot of loan growth has come down by a larger percentage for the top 25 banks in the US, we've actually seen the opposite with some of the rest of the population of the banks. So I think the higher level of scrutiny on some of these larger banks presents opportunities for our, smaller community and regional banks to really put their foot in that door and compete on some of those deals that they probably weren't getting the same sort of look at in the past. And so I think, again, with utilizing a swap program, the whole purpose is it puts you on a level playing field with those larger banks from a pricing standpoint. So it's a great time, this point in the market, kind of turning a con. Everyone hears regulation, they hear con, but it gives you a way into that market, and it gives you a way to increase your market share. So there is a little bit of benefit to come out of this high level of scrutiny that we've seen recently.
Okay, great. So we have one other question. This one came in from Susan, who asks, I work at one of those banks you referenced whose commercial loan growth has been quiet for a number of months. What are some strategies you're seeing to stimulate and present new opportunities for my hedging program internally?
I could take that one. I think, I mentioned one before with utilizing that forward starting swap. I think, again, I'll hammer this point home, is that your existing loan tape is the lowest hanging fruit. And so I failed to mention, it's not only deals that are maturing in the next 1 to 2 years, but if you have one, I think typically when banks were extending credit on a fixed rate loan basis, you have repricing every 5 years. So if it's one of those deals that is coming due that reprice at the 5-year mark in the next 1 to 2 years, the same concept applies. So you have those opportunities you could look at for one. And I think, just because commercial real estate lending is coming down a bit or has come down a bit, there's still other opportunities within your bank lending space that you could look to apply your swap program to. We've seen a spike in C&I hedging. I mean, I think historically, when you look at the past 5 to 10 years, customer hedging programs have been 90 to 95% based on commercial real estate loans. That dynamic has started to shift recently, where now it's closer to 60 to 65% are commercial real estate deals. But C&I has been a major market where you could look at doing new hedging, and there's no real limitations as to what you can hedge. There's no minimum size, there's no minimum term. So bringing forth an opportunity on a 3-year hedge has become relatively commonplace in Q1 here. So you have that opportunity available. And then along the same lines, looking at lines of credit, if you have an evergreen amount that's going to be outstanding on a line or a revolver, you can look at hedging those and reducing your customer's interest expense anywhere from 20 to 75 basis points on day one. And I think at the very least, having that flexibility available, customers appreciate you reaching out to them to give them options. So that's a great way to show your customer that you care, give them these options. And to be honest, a lot of them like the idea of being able to immediately lower their interest expense, and it really protects them. If we do go back to one of those scenarios that we talked about earlier, where it's a higher for longer environment, then it's just a great win for everybody.
Great. Well, that was very insightful all the way around. So as we wrap up today's discussion, I'd like to be the first to extend a heartfelt thank you to our panelists, Frank and Isaac, for their invaluable contributions and their analysis. Their perspectives on navigating this interest rate risk in our derivatives market has been most enlightening. To our attendees, your engagement and questions have truly enriched this session. We thank you for your questions. We hope you leave our webinar with actionable insights and a clearer understanding of the complex dynamics at play in today's financial landscape. As a reminder, a recording of this webinar, along with the presentation slides and additional resources, will be made available to all attendees. We encourage you to review these materials at your convenience to further deepen your understanding of the topics discussed. For ongoing updates and insights, please follow Derivative Path on LinkedIn and visit our website. Your continued learning and adaptation to these market changes are crucial. We're here to support you every step of the way. In closing, as we head to Q2, let's keep this conversation going. The challenges and opportunities in the interest rate derivatives market require our collective attention and expertise. Together, we can navigate these complexities and position ourselves for success. Thank you once again for joining us today. We appreciate your time and look forward to welcoming you to future discussions. Have a great day.